Good morning, everybody, and welcome to the Daily Energy Markets podcast, first Sunday of the month in review and month outlook ahead. There's a lot to talk about, inevitably, as there is every first Sunday of every month. But meanwhile, the oil price is kind of flatlining with some recent moves. Is this the beginning of some departure from the $65 handle where Brent crude oil has been stuck like a barnacle on a rock for some time now? We've seen in recent days that move a little bit away from that. Let's welcome our special guest today. Obviously, as always, Christophe Roule is with us, an anchor of the Sunday in Review, senior research scholar at Center on Global Energy Policy at Columbia University, and his special guest this month, Antoine Half, co-founder and chief analyst at Kairos. Let's start with Antoine, with the sort of fundamentals, as this is an oil market that seems to be deflating from geopolitical risk and starting to explore maybe what are the fundamentals of supply and demand. Antoine, what's your big takeaway month in review, the biggest sort of supply demand data point announcement of the month past? To me, it must be high on the list is OPEC Plus's decision to continue with supply increases. They announced that about a month ago. Your thoughts looking back, biggest issues, biggest relevance for supply and demand?
Well, I agree. Any decision that OPEC takes on supply is bound to be at the top of the list. The question is, what's the difference between the announcement and the delivery? Is OPEC delivering the entire production increase that it's advertising? And I think that's a question mark. On paper,
How
more.
big of a question mark? I mean, ultimately, we've enough 6 months of their quote increases, 2.2 million barrels in the second and third quarter. So we have some real evidence to assess how serious this is. Paper barrels or real barrels?
It looks like there is definitely real barrels from Saudi and from the Gulf, but there's constraints, production constraints, capacity constraints elsewhere. Russia has its own issues and looks like it's maybe bumping against capacity constraints. But if you look at the big picture and how this fits with the rest of the market, you would think that an increase in OPEC supply is going to be bearish, it's going to push the price down. We're not seeing so much evidence of that. And if we look at crude inventories around the world, and we have a pretty good handle on what crude inventories are, because we have now daily measurements, satellite measurements of 95% plus of capacity. We don't really see fixed roof tanks in Russia, or the few that there are in China for that matter. But we have a very good, almost entire full view of inventories. And what's interesting is inventories look like they're not really falling. They're not really building. We see a little bit of a rebalancing, and the rebalancing is also geographic. We had seen strong builds in China. Those have reversed, and in the last since mid-September, we've seen actually draws in China of about 60 million barrels up until about 2 days ago, and a build in the rest of the world. So equating to a very small draw worldwide, 2 million barrels. So a little bit of a rebalancing and inflection point. Big question, of course, on the state of the U.S. economy. Questions about the quality of U.S. statistics, but questions about the resilience of the economy in the face of uncertainty, theatrics from the Trump administration regarding tariffs. So that's more of the same, I guess.
Christophe, your thoughts, picking up on that, Antoine mentioning there the outlook for the US economy, the sort of big macroeconomic takeaway of the last month, I would suggest, is the Fed finally sort of succumbing to the Trump demands of lowering interest rates. How big a moment was that? How do you see the wider macroeconomic review in a month behind us?
The outlook is still sort of surprisingly resilient, I think, overall. But let me start at the other angle first, because if you look at last month and it feeds into the economy, I would start on the geopolitical thing. The most significant event, obviously, is what we're just starting to see happening in Gaza. But a very significant, less often discussed appendix to that appeared. I just saw it by accident this morning in the Financial Times, namely that somebody made it known that the US was providing intelligence to Ukraine for this long-range targeting of energy infrastructure. And there is, this discussion bubbling up of delivering Tomahawk missiles or then the German long-range rockets down the road to Ukraine. So this kind of leak from some unnamed informers around Trump's narrow circle should give us a hint that on the top of Gaza, which didn't quite, materialize in a Nobel Prize, there will be a renewed effort to pacify or stop the Ukraine-Russia war, which might be a good thing, but it will not be as what we have seen before. It seems to be serious that it will support the Ukraine in attacking what has proven to be very successful, the Russia energy infrastructure. So that's something we can come back to. On the economic side, we have seen the hiccup. This was probably most significant last month now with the trade war in China again, which I think markets will take to be a hiccup and which probably will be one when the stock market reacts in the usual fashion. And then the administration sort of finds another temporary stopgap measure to have quietness on that front. I think what we are seeing,
but it is at the end of the day,
the economic picture is not as great.
Just picking up on that China point, Christoph, the idea that we've seen in recent days, and of course we've all been sort of asleep to what exactly is the China-US trade war at this point. Of course, it's at a pause, a 90-day pause as announced in the end of June. That is coming to an end, and the Chinese are putting firmly out there some sort of hard task position, i.e. around the precious or the minerals that are required for the digital AI age. At some point, this China-US face-off has to either be a knockout punch or a full bear hug of love. How do you see it? I mean, these are critical weeks looking ahead.
Yeah, this was a surprise to me what the Chinese did actually. I didn't expect that, and I still have no good explanations. It's like you said, this is the first time that somebody outside the US started this kind of trade war, if I use the term, when they suddenly slapped restrictions on the exports of rare earth before an agreement had expired. Now, you could say this is just hardening their position in front of, for better negotiations, or you could say they underestimated the shock this would cause and the upset this would cause to the US administration. But either way, it unleashed the response from the US. It wasn't Trump moving first for this time. And it certainly is not a good sign in the long term. In the long term, economically, those two guys are very dependent on each other. Everything which blocks trade will have a detrimental effect to long-term economic growth. And in general, I think what we are seeing, as Antoine has mentioned, the data situation is becoming more miserable out of the US after the shutdown. But what we are seeing underneath the fog is a weakening economy. Is inflation being sort of fixed where it is and with probably an updrift, but the labor market weakening. And I would maintain that when you have these kind of tariff situations, you need these adjustments. That is something which in the long term doesn't bode well for economic growth. But the really big economic picture is this relentless running up of deficits and then debt of the economy. And that's not unique to the US, that's the whole Western world. And this is where the main trouble will come from once we see deleveraging in the stock market and all that.
Antoine, I wanted to pick up on your comments there regarding global inventories. I mean, I was in Singapore a few weeks ago for the annual APEC conference, of course, world's largest gathering of the midstream sector of the traders, etc. And the surprise of the week discussion point was China's increasing inventories by about an average of 500,000 barrels a day this year. That was kind of like the, oh my God, I can't believe it, as if that was something that was surprised the market. And yet a data point that was quite supportive to prices. You're indicating that that might be over at $65 on Brent. Surely the Chinese will want to be buying more.
Yeah, there's all kinds of numbers about Chinese stock bills making the rounds. Not all of them are necessarily accurate to the barrel. I think we have some differences in our company. We monitor Chinese stocks and stocks globally, but there's been a change. I mean, in the in April, May, June, second quarter, there was a very massive increase in Chinese stocks. Then that slowed down, and then now we're starting to see what looks like it may be a reversal. It's maybe a bit early to extrapolate from the trends of the last week or two, but there's a little bit of a shift. Going back to what Christophe said, I mean, Gaza, obviously huge news. This has been one of the biggest flashpoints in geopolitics. It's remarkable how little impact it seems to have had on the market, on the oil market specifically. And I'm
Well,
not
certainly the general discussion point through the year has been how tragic as Ukraine and Gaza in particular have been. They haven't been threatening to global oil supplies and so consequently haven't built a geopolitical risk premium. And yet in the last few days, we've seen a real deflation in Brent on the news of Gaza.
There was
Yeah,
also the news of the trade war, no, that came
That's
together.
true. Yeah.
before the trade war. Yeah, I mean, even when there was direct strikes between Israel and Iran, there was not much of a market response, which was really kind of shocking to me because coming from the IEA, where I worked for many years, when we had emergency simulation exercises, a direct conflict between Iran and Israel was something that was assumed would push the price to triple, multiply by three or two. Or,
At least for a day or two, right?
yeah, it was
As we
the
saw with the
most
start.
catastrophic scenario, and we haven't seen any of that.
Yeah.
Partly because the conflict has not really hit the oil infrastructure, particularly the export infrastructure. Also, I think the transparency that we have on the market enables the market participants to have an exact view, immediate real-time view of what's going on. Less need for safety cushion and more ability to rebalance the market as imbalances occur.
Well, I guess
Christoph,
if I
yeah,
can
go ahead.
interject, I guess the nugget to be explored is whether it is true that Chinese inventories have actually stopped rising the last few months. And if that is the case, if Antoine's observation, which are sort of counter to received market wisdom, right? If they are correct, why that is the case? I mean, we all agree that the OPEC increase has less of an impact because it is not implemented to 100% because they can't bring up production as much as they promised for various reasons. And then the market's explanation really was that it all is being sucked up in unrecorded inventories in China. I think so. The question is that true? And then why would it slow down right now if the satellite observation is correct? I have my doubts. I think the Chinese economy is tugging along and they do exactly what we have discussed here many times they would do. They have the will and the capacity to stabilize it around somewhere 5% growth. There will be no return back to 10% growth rates, but there will be no disaster. These different bushfires which they have in the property sector and the regional sector with semi-government debt and all these things, this is something which is controllable and has been controlled so far with hiccups and all that. So why would inventories? I find it hard to believe that inventories were suddenly drawn in China. There's no spurt of economic growth responsible for that. There may be a slacking down. There may be even a slacking down of exports from Russia for obvious reasons.
And there is a massive commitment in China for everything that resembles security, energy security, food security, every type of security. So capacity building and inventory building through the prism of energy security,
That's
if
where I was
for no
going. So
other reason.
I think they're
China is a
sitting
big
on their
country.
hands until prices come down. That's what they're doing.
I think China is a big country, and there may
Yeah.
not be a single explanation to explain
Yeah.
such a large economy. I think part of the bills that we saw, particularly in 2Q, part of it was new strategic storage capacity that was allocated to strategic stocks. Part of it was, and there were new facilities that had to be built to be filled. There was new refineries. So if you start picking at the numbers and looking in detail where they come from, where the bills come from, the so-called teapots or the state-owned companies, strategic stocks, commercial stocks, there's a little bit more logic to what's going on. So I'm not sure that the decline we've seen in the last 3-4 weeks is going to continue, but certainly we've seen a decline in the last week.
It does seem interesting, Antoine, that the inventory builds in China, however big they may be, and it seems to be, on the general sense, substantial over the course of the year to date. But ultimately, that is seen as bullish to the oil price. It's supportive. Whereas if we saw a corresponding build, let's say in Cushing or in the US, it would be very bearish for prices. What's the divergence there?
True. Well, as stocks start seemingly drawing in China, we've seen the reverse in in the US. So we've seen in the rest of the world, we've seen a little bit of a build. We continue to see Cushing stocks very low, but the market is now used to working with very low Cushing stocks. It's amazing. I mean, at current levels in the past, we would have seen much higher prices, I think.
Christoph?
I think the premise is wrong. I don't think the inventories in China are seen bullish for prices. I think what we've seen is that the question was, why didn't prices rise more in response to these OPEC supplies and increases? And part of the answer is because part of these supply increases disappear in unrecorded inventories in China. So if there would be transparency and they would shown to be rising, that would be negative for the price, not positive. But I think that it also the last few weeks that coincides with the Chinese campaign to restrain activity at their refineries and to streamline that system. And I think that also will have contributed to. So I would not overstate the case that the Chinese are suddenly growing fast and withdrawing inventories, because I don't see evidence in the logic. I don't see evidence in the economic growth rates. And I see just an attempt sort of to manage the system better, given that they have increased capacity by so much. Admitting that the jury is still out on whether there are more or less inventories now.
Antoine, just to look at the question where a lot of these tangential roads seem to come together, for me at least, is the idle capacity, right? The question in the first half of the year, why didn't prices react to very stressful geopolitical moments like the Iran-Israel conflict, was because there was a general sense that there was a lot of idle capacity. OPEC Plus had only started to increase, and there was generally a market understanding of 5 to 6 million barrels a day of spare capacity, shut-in capacity, however one wants to call it. As we come to the end of the third quarter, now in September, the question starts to emerge, OPEC has made these increases, whether they're paper or real or a combination of both, but the outcome is there's less spare capacity now. There is now maybe a shift of a stress concern about that, the fact that the system doesn't have too much string for an uncertain moment to happen. What are your thoughts on where we are in that sort of nexus of lots of idle capacity now shifting to, not so much?
It's always a trade-off. So you increase OPEC supply, you decrease capacity. I think that's a real issue. The other side of this, which we haven't touched on yet, is US production and shale production, what's going on with shale production. We see a little bit of a potential drop in US production, more than what's been factored in by the EIA. So the EIA, I think, is forecasting a 1% drop in US supply. We see potentially much more because we see, again, a kind of inflection point recently where the continued drop in the rig count and the frac crew count is no longer being offset by the increase in laterals. We have something called the reservoir exposure index, which is basically the well count multiplied by the average lateral length. And the well count had been dropping, but this was offset by the increase in lateral length. That's no longer the case. So in 3Q, I think we've seen compared to 1Q, we've seen a drop in completions about 12%, but the laterals have only increased by less than 3%. So we see what we call a 9% drop in the reservoir exposure index, which would lead to a significant decline in production, more than what the EIA again says, 1%.
Christoph, just taking on that point and looking forward in the IOC universe, obviously we're seeing layoffs in the IOCs with the lower oil price, lower revenues. We're seeing perhaps less investment in new capacity, and OPEC Plus raising supplies, paper or otherwise, indicating they've less idle capacity. Where do you see that issue going forward?
Well, I remain of the opinion that prices in the current demand-supply balance globally have some way to go down. I also think on the US shale, I had a discussion with Anton before. Anton, we have a different opinion there. I think collectively, if I take the collective of oil analysts, The one point where they all have been wrong the most was in permanently underestimating US shale since it first emerged. This is very flexible. It's
You mean
very,
over the last 15 years, basically?
yeah, all the time. It is fast in responding. We know that in the oil industry, prices follow cost follow prices. So once you have these huge price swings, the markets adjust. The rates of return of companies don't really significantly change. It takes different times for it to adjust. It takes 18 months to 24 months in deep water projects because they're very difficult and long term to do. And the shortest adjustment time is onshore US and probably in shale even shorter than what we have historically measured with these little donkeys everywhere. So shale, I wouldn't worry so much about, but it is more the general what you said now, the disappearance of. So two things here in the long term, as we discussed very often, the fear of a stagnating oil demand and therefore the desire of low cost and Gulf producers to maximize their capacity to be ready for a low price environment and at least be capable of increasing volumes. And then what could upset that balance, of course, is that we are seeing a confluence of these two things: realization in the market that spare capacity is going to be scarce in a scenario like that. And these developments again, which we started out with Russia and Ukraine, the realization that probably short of a military intervention, the only way to end this war is to really cause pain to Russia's economy and changes in Russia. And the only way to do this is to cut off their energy and ultimately oil exports. And the only way this could be done ever and can be done in the future will be to inflict some pain on the consumer in the West, in the G7. And
Yeah, but China would have to be a major partner in that ability to shut down Russia. And a cleaner, it seems that China's quite content to have this war continue in Europe and suck in American and European geopolitical bandwidth and weaponry and so forth, all the less their ability to deal with the South China Sea and Taiwan. So I see China being a big factor here in any resolution to the Russian-Ukraine war, and I don't see any incentive for them to allow it to end.
I agree completely, and precisely because China is so important in this game, and precisely because China will be remaining unwilling to support anything to change the war. That's why the point of intervention will have to be at the production facilities in Russia ultimately.
Looking at the sort of month in forward, Antoine and Christophe, and just sort of taking a hard look at the month ahead, we're now mid-October, the last quarter of the year. The general narrative all year has been that all of these issues percolating right through all of the markets, but ultimately that the supply increases and the weakening demand would finally show itself in the fourth quarter. Even at APEC, there was at the APEC conference forecasting a $10 oil price decline in the fourth quarter on Brent. Where do you see things going, Antoine, now? Are we finally going to get this oversupply and with it the big weight down on the price?
It's a very perilous exercise to forecast the market, even short term nowadays, because there's so much uncertainty, especially in the US with the US economy, Trump announcements, volatility in statements from the White House, and uncertainty about the figures in the US. I think the big question is.
You mentioned that a few times now, Antoine, the uncertainty about the figures in the US. Is that now another factor in the market, that the data coming out of what has been for much of 100 years a very reliable data source of the US Statistics Department is now something that has to be cynically reviewed?
Well, clearly, with the firing that took place
in August.
In August, a couple of months ago, I think a lot of eyebrows were raised and concerns were voiced, and I think those concerns are legitimate. Now, I think we could see some reversals in US policy. We're used to that now, so we shouldn't overreact to the first headline. The US has the best statistical organizations, economic statistical organization in the world, so it's going to take it would take a lot of effort to tear it down entirely. But there are questions, and there are questions separately from the quality of the data, just about how long it takes for policies like tariffs to impact the economy. We've seen the economy being more resilient than people expected, the global economy being more resilient. Maybe it's just a question of a lag, and maybe it looks like we're seeing now unemployment on the rise, inflation showing up in the numbers, and we could see. The question is, are we going to see the economy take a hit and oil demand take a hit in the last quarter? That would be a factor.
Christophe, your thoughts on that? I mean, the Fed, as we say, moved last month, the first cut, I think this year. Your thoughts on where they go, trying to read the tea leaves on all of this?
Tea leaves is going to be the writing. I think this is a dangerous situation, this curtailing, what autocrats do, curtailing data, precisely because the US data was perceived so that the gold standard. Once you start shooting the messenger, it's not that you have to dismantle carefully a complicated statistical bureau and that will take years. No, it is when people start to get suspicious and you have already this conspiratorial mindset of social media and everybody being allowed to say anything and being multiplied for it. When the doubt creeps in on the data side, the doubt is enough to make many of these announcements much less effective than they used to be. That's certainly something which we will be see, which unfortunately seems to be already on train. On the US economy, I do think that we are seeing a weakening. I think that we have obviously a stock market which is sort of probably priming itself for correction. We have overcapacity in the buildup of electricity production, semiconductor production, everything feeding into AI, which people often name as the trigger point. That's probably 1 to 2 years away. But we do have private equity investments in all sorts of areas which are waiting to go sour or are going sour and not being published yet, like this huge car supplier. Which is there, and we have an unstable environment, which Antoine mentioned, supported the instability by the US administration, which can pose additional surprising triggers. So there is potential for a little hot air getting out of stock markets, and that could affect leverage in the economy. And we have an economy which is still running year after year with very high deficits. And to me, it's the hallmark of this kind of, I don't like the word autocratic, but for lack of a better word, authoritarian regimes, they always, always, always mess up the economy by having deficits too high, then inflation creeping up, then not being capable of dealing with inflation and deficit reduction. And I see something like that happening in the US, although it will be much more subdued than elsewhere because of the reserve currency status, which they are not about to lose tomorrow, no matter what the blogosphere says.
Antoine, just to finish off with where OPEC Plus could go in the months ahead. Obviously, we're now 6, 7 months into a supply increase era after years of cutting. This, you would say, despite the fact that oil prices are well below the target they need, at least in the Gulf, for budget break even, fiscal break even. So they're all covering fiscal deficits. The idea that they're continuing to increase, they announced it just the other day. What's your outlook for that and where that intersects with their fiscal health and this policy to continue to increase supply despite a weakening demand outlook?
I think they're doing the right thing. I think the increasing supply is the right thing for them to do to regain market share and eventually to lead to a price rebound in the longer term. It's not unusual. We had a discussion about this with Christophe and we disagreed, but it's not unusual for the rebalancing of the market organized by OPEC to sometimes take the counterintuitive form of a supply increase in the face of lukewarm or diminishing demand. That can make sense. And I think it's going to make sense this time. There's question marks as to how much OPEC can really increase. There's question marks about Russian capacity. There's question marks about whether a decline in US might offset a little bit the OPEC increase. But if it offsets the OPEC increase, the job is done. That's OPEC is regaining market share. That doesn't mean that shale is off the table. Shale is going to rebound at some point. There's going to be probably a wave of restructuring, consolidation in the shale industry like there's been before, leading to a new wave of improvements in efficiencies. But that's in the longer term.
Christophe, your thoughts on that? I mean, when Antoine talks there about market share, it seems in ways as much about market share within OPEC Plus getting balanced out rather than outside OPEC Plus. Who can produce what and then let's readdress our quota balance. Your thoughts on the outlook going ahead for why OPEC Plus are doing this and what they're looking to achieve?
I think that's a very astute observation. It's as much about market share within the organization like anything else. I still see in the global discussion this word market share injected, and I still have only one good explanation for why somebody should have the willingness to increase its market share at the expense of its revenue, because that's what's going on. And that good explanation is that you're looking into a future where you want to have your capacity as large as possible, as utilized as possible, because you are dealing with lower prices and because your only way of maximizing revenues is maximizing volumes at the expense of other producers, of higher priced producers. And you do that by undercutting them in price. So to me, this is still, it's astute. They're doing the right thing from their perspective, but their perspective is one with a medium to long-term worry about, call it peak oil, call it plateau oil, call it weakening demand of a market where there's a lot more competition on the supply side than there used to be, and where there is a risk of only the cheaper suppliers being able to win it. This is not just some cyclical adjustment. They have never been, I disagree with Antoine, they've never been good at this. They always run behind history on it.
I mean, how more do they go?
By increasing production, cutting production, increasing prices, and new provinces on the back of these higher prices. The North Sea, Brazil, they all came back on the back of these high price phases. And then that's not going to help them if demand stops to go up in this regular fashion, which we have seen for 100 years.
If demand stops, well, it's not going to stop in the fourth quarter and it's not going to stop today, but it's certainly at some point these increases in quotas will start to be redundant because nobody can increase except for one or two countries. What does that mean within the organization? So that's a space to watch over the coming months. But for now, we have to wrap up our month in review outlook ahead. Thank you, as always, Christoph Ruhl, for anchoring this very important session every first Sunday of the month, and Antoine Haff for being the special guest this month. Great to have you. Please come back again soon. I really appreciate your time this morning in Paris and Christoph in London. We'll catch up with you all again soon. All the best.
Thank you.
Thanks. Take care.